Hello and welcome to this ED Now special Budget Dialogues with Deloitte. I'm Anisha Jain. Well, Union Budget 2023 is right around the corner, and we here at ED Now have been speaking to a battery of guests to understand what could the government actually deliver to propel India towards that vision of achieving the $5 trillion economy. To decode just that and talk to us about what could be the streamlining that can happen as far as taxation structure is concerned, today we are joined by Mr. Anisha, partner Deloitte, Mr. V.S. Parthasarathi, Vice Chairman, All Cargo Logistics, and Mr. Ashley Menezes, the partner and CEO at Chris Capital Advisors LLP. Gentlemen, hi, thank you so much for making time and speaking with ET Now. Amrish, let me first come to you and discuss with you the most talked about subject, and that's about the rationalization as far as the capital gains tax is concerned. Now, we all know there is a bit of a case there given the fact there's a lot of dichotomy and lack of parity with respect to the tax rates, duration, etc. What's your own expectation? What could happen in terms of tweaking the capital gains tax?
Right. So I think clearly there is a great expectation from both the industry Inc. and the investors to see that the tax rates on capital gains are streamlined on two counts. One is the rate counts. Today there is an anomaly between what are the rates when you are holding an unlisted company versus a listed entity. Secondly, there is another anomaly between what is the rate applied to a non-resident versus what is applied to a resident. So I think those anomalies need to be addressed, and we need a single rate. Similarly, the period of holding is different. So for listed stock, which is traded on the exchange, the period of holding is 1 year for long term, but for unlisted it becomes 2 years, where the real investment comes in most cases, on the ground. So I think those are the areas that the government should look at from an overall perspective and just streamline those, whichever way, whether it is 1 year for everything or whether it is 2 years for both type of stocks. I think that's what is the need of the hour from an overall perspective. And if one looks at it as to what developed countries have, they have a single rate for short term gains, and they have a single rate for long term gains. Again, the period is very well defined for all types of instruments, whether they are equity or whether they are convert instruments. So I think we need something very similar to make it simple and easier for people to decipher.
Well, let me bring on board Ashley as well into the conversation. Ashley, what do you expect with respect to the tweaking as far as capital gains is concerned? What's on your wish list? Because you exactly are on the ground and you face all of these roadblocks when it comes to the capital gains tax as well, the unlisted space versus the listed space. What's your wish list?
No, sir, Anisha, thank you. I echo, what Amrish said. I think there needs to be an overall rationalization of rates and regulation, so that it's a simple regulation. People are very clear as to what applies. I think what's most important, especially to attract capital in private equity capital, tends to be long term, where we are investing in typically unlisted companies, taking on a significantly larger share of risk. And accordingly, to have a scenario where on unlisted gains, one is paying a higher tax rate, that doesn't, bode very well. And that's not something that you see anywhere in the world, as Amrish said. So that is something that is most important for us. I think, if there can be rationalization where money is actually getting invested, as opposed to on the listed side, typically it's a secondary transfer. So, it's important to bring parity to investors who are actually bringing money in.
Sure, that point is taken, but Mr. Parthasarathi, while there could be a lot on the wish list as far as corporate as well as deal makers are concerned, what is the possibility that the government will be actually able to deliver this? Do you think this could have a big impact on government coffers that could act as an impediment to this rationalization?
Thank you, and this is a very interesting topic. And in a broader sense, you are saying how can we get more funds and more money infused into the unlisted space and help them grow, companies in India Inc. grow faster and bigger. And PEs and investors from outside have a large role to play in it. So if you look at it from a very aspect of how to spur the growth, it will be important to make a level playing field from this point of view. So what Amrish said, what Ashley said, I concur. Even from an industry point of view, we would like to attract more capital into India, and more capital will come when this kind of anomalies go away. In a listed space, it's easier to invest in some sense. Unlisted has more uncertainties. So when we make this kind of peak which benefits them, it should overall be very helpful for the industry and especially for the investors. Now come to government. That was your question. So why should government do it at all? I think India is struggling to attract FDI versus a lot many other countries which are also vying for this capital, and successfully in many spaces, but it would like to do more. And I think the velocity that will change because of such laws should make up for any small dent in the coffers.
Let me take that point across to Amrish and scratch it further. Amrish, what Mr. Parthasarathi talked about, more clarity, more certainty with respect to advanced rulings, etc. as well. What more can the government do, whether in terms of a single window, etc., that could help attract those foreign flows?
Yeah, Anisha, so before I answer that, just one more point on the previous one. I think if you look at, the way the corporate tax rates have been streamlined, they've gone down to 25% in most cases if you're not taking any other, benefits of exemptions. And if you look at the long-term rate, which is generally 23 odd percent, I think there's any gap between, a long-term rate and a normal tax rate. So I think even that calls for, a rationalization of the long-term rate for assets which are like unlisted shares. But just coming back to your point, I think what India Inc. Is looking at and what investors are looking at is how to make deal making faster, and that is where the regulatory aspects do come into play. More importantly, we need something like a single window clearance, which allows any deal to be only looked at by a single body, and then internally whatever approvals are needed from different departments or different regulators are sought by that body, so that there is a direct access to that body and a direct discussion rather than talking to 5 different regulators and each one will have their own points of view, and I think that authority becomes the final authority to decide any case where there is a regulatory approval needed. I think that will give a lot of confidence in terms of making investments into India, and that will help deal making in a long way.
Mr. Parthasarathi, come in here, because from a corporate Inc. point of view, you have been very close to the ground, whether in your earlier role at M&M or now at All Cargo Logistics, wherein there have been a lot of M&A deals as well. What's been your reading and what's your ask when it comes to streamlining and easing the deal making in the country?
Thanks, and it has indeed been across industries when it came to M&A exposure and experience. So one of the big things that I always end for is certainty. It will be very difficult to do a deal and then somebody else comes and says, hey, restart this whole equation. And therefore, if to add to Amrish's point, I think single window will help, but I think more importantly, certainty will help. And where I come from, certainty is if there is an advance ruling, if withholding taxes are much more clearly clarified, and how to act on what are the tax incidents on a thing, how to get CCI approval. So then the overall clarity will make the deals faster and better. And of course, one faster and better, which has to be that how fast can NCLT try to wrap up a case. Also comes into play. But from a tax and a taxation point of view and a budget point of view, it is giving certainty and how to give certainty to transaction and how to give faster clearances. That will be the very important thing in M&A transaction. That's one thing which my foreign investors and my foreign collaborators has always asked of me, and if I'm able to do along with the government, then that will be a delight for them.
Well, yes, certainty remains that important part, and actually that is something which is lacking when it comes to the private investment space, right? There's a lot of ambiguity and ambiguity around the AIF model and the comparison with the entire startup world with respect to taxation, etc. What is your ask when it comes to the private unlisted space and the taxation there?
Absolutely, Anisha. So to add to the two C's that my co-panelists have talked about, which is clarity and certainty, I would add a third C, which is important, which is consistency. Right. So from a regulation perspective, private equity investments are a 10-year product, and one would like to see consistency of regulations, because if you raise money and if you're investing, you want to be there for at least 10 odd years, and you want to have the regulations to be consistently applied. And so that is extremely important. So the AIF industry has been relatively new, but most of the regulations or clarifications have not really come in because of the kind of structure that AIFs typically have, to have formerly been more of a trust kind of a structure. So to give you an example, in most companies, when there's a startup, the entrepreneur gets a large portion of that upfront, which is the promote. And there's clarity in terms of when that entrepreneur sells it, it's clearly capital gains. In the case of private equity, for example, that is called carried interest, and there isn't much regulation on that. And so there's been recently a case from an indirect tax perspective, which has taken the view or suggests the view that this is more in the nature of an income as opposed to gains. Right? So this is something that we believe, if there are regulations that are put in place, there is certainty and there's consistency of that regulation, it will give a lot more comfort to investors, and that will attract a lot more capital into India.
Interesting. Let me get Amrish also back into the conversation. Amrish, anything you would want to add as far as the entire consistency that Ashley was pointing out, or rather the lack of consistency as far as the regulation is concerned, and also a word as far as the contingent consideration is concerned, because that also is something which is a bit of a gray area, right?
Yeah, absolutely, Anisha. I think one of the key things that we're seeing in deals nowadays, and especially the new age companies, the fintechs and the health techs and the ed techs and all this, there is an element of consideration that the investor is willing to pay, but subject to meeting certain parameters. Now, how do we structure such a thing? Because there is no clarity today, because they may buy the shares today, but part consideration is paid today, which is what is agreed, and then a part consideration is payable later based on what the company is able to achieve. Because in many of these cases, the founder members are still part of the team working as part of the operations, and I think they do bring those financial parameters into play. Today there are decisions on both sides, and you get into a debate every time, depending on which side of the table you are, the seller's side or the buyer's side. And you try to put that case law in front which is most beneficial to you. But I think a clarity there would be needed, because there have been cases where if you let's say paid tax on a full amount which includes contingent consideration, but at a later date that consideration is not payable because those circumstances have not been met. How do I get my refund? How do I say now my income was not X but Y? And that becomes a big challenge from an overall perspective. So I think that clarity is that if the government can say that contingent consideration will be taxed when it accrues to the seller, I think that would make it absolutely simple and clear for everybody to play. But I think there is also another angle which it's on the regulatory side. Our foreign exchange regulations have restriction on the amount that can be put under contingent consideration, as well as the period for which it can be. And I think in deals, where we've seen larger period than the 18 months that is prescribed under the FEMA regulations, or the 25% of the consideration, it becomes a sort of a hindrance. And then, you need to start structuring how, the same can be achieved in different ways. But I would feel that, again, simplicity here would be clear. Let it be, a reasonable period. We are not saying that you make it 10 years or something, but a 3-year period, seems to be more reasonable. And I think the quantum should be led to the commercial wisdom of the parties. So long as whatever has been paid for the price today is a fair value, I think there should not be any other issue from that perspective, because it's only a top up that somebody will get if the financial parameters are met.
Ashley, in your own conversations with overseas clients and the international transactions as well, how big is the challenge as to what Amrish just pointed out, the FEMA regulation, the 18-month cap, a bit of a wriggle room available as far as the valuation is concerned?
No, no, absolutely. It's a complexity that is completely not needed, right? It is the word that Amrish used is absolutely right. We need simplicity. So besides paying contingent consideration based on certain parameters or certain contingencies occurring, there are genuine situations where you're paying consideration and you want to hold some of that in escrow because there may be indemnities, etc. An 18-month period is too short for that, right? It's not even 2 audit cycles to really see whether things really pan out. And we know, for example, one of the reasons people hold back some of the consideration and put it in escrow is for things like tax litigation. We know how long some of those things take. So an 18-month period, is just not viable. Unfortunately, people have to resort to creative structuring to try and do what the intent of the parties are, and that just is unnecessary complexities that is something that's completely avoidable.
Oh, well, yes, absolutely. And the other thing which has been seeing a lot of creativity is the structuring of ESOPs, right? Because there as well, there is a bit of a lack of clarity as to how the taxation would really evolve. And that leads to a lot of confusion, plus as well the structuring as you talked about. Let me bring in Mr. Parthasarathy back into the conversation and understand from him, what could the government do perhaps to streamline when it comes to ESOP taxations?
Thank you. Thanks for asking, because in the entire gamut, the employees and other stakeholders, not just the employees, but also now we are forming different kind of association with the company. The traditional employment is changing dramatically, and ESOPs are stock options in all those contexts needs to be seen. But just before that, one small point on the earlier one. The timelines has to be longer. The percentage which is currently, if I understand correctly, Amrish, is 25%, of the consideration. But just nowadays, the profits and various parameters are oscillating so much that, I don't want to pay 75% upfront. I may want to pay something lesser. And on contingency of a certain event, I may like to pay something more. So it needs to have that flexibility and percentage as well. And the third one is certainty of when this will be taxed. And it should be taxed when it is thing. So just wanted to kind of bring that to a logical point from an industry perspective as well.
Amrish, anything you would want to add on the subject? Your take?
Yeah, I think there are 2 parts to this ESOP. I think up to the date that it is linked to a service provided or employment provided, and the period after that. So there are 2 streams of income if one has to look at it. And I think today what is happening is, because in an unlisted space in particular, there is no liquidity event. There is the dichotomy that should I go in for saying that my ESOP is now exercised. And therefore it stops my stream of income as employment or of service fee, and thereafter my capital gains or the holding of an investment starts, because as we saw that if this stock were to become listed, it could have a lower tax rate as for today, unless they change and bring everything on or to parity. So I think that's the big dichotomy that all of this employees and contractors and and therefore the deals are becoming slightly more complicated to how to achieve this entire equilibrium between what is the service fee that is subject to tax when there is no cash versus what should be the capital gain. So I think there is a lot of clarity needed there, that how will it be treated, and can it be say that while everything will be taxed at a later date, but let's say the period from the day the service stopped or the employment stopped can be considered something to say that it was a holding of an asset, and therefore capital gains will apply from that day, and you do a fair valuation and apply it accordingly. It's slightly complicated, but I think we will have to think of a more innovative way to deal with this.
No, that's interesting. And Amrisha was going through the pre-budget document as well from Deloitte, and one of the asks was regarding, the deemed income as well, especially for IBC cases. If you can help us understand the concept for our viewers as to what deemed income really means and what kind of, streamlining can happen there to spur the demand as far as the IBC case resolution is concerned as well, because that is where you need a lot of capital and confidence to come in from private investors, right?
Absolutely, Anisha. I think you see, if you look at IBC, what are the 3 or 4 objectives of the IBC? If one has to look at it, first I would think is revival of that business, because there are a lot of stakeholders, employees, who are dependent on the company running or the operations running. Second, obviously, a lot of lenders who have lent money want to recover as much as they can. I think those are important elements. And the third is, in a way, the stakeholders, if there's anything left, but generally there is nothing left for them. But the first 2 is very important. Now you look at it from an investor's perspective, right? If he is going to put in money and he has to acquire the shares because he wants to take control of the company, that is not possible today, because generally what we have seen in IBC cases is that the stakeholders' value is almost zilch, because the creditors are not able to recover their full amounts that they have lent, and therefore if there is a price listed, let's say of something which is zilch at even, let's say 8 rupees or 7 rupees, and we've seen those cases, if the investor were to acquire these shares, then he is deemed to have acquired a share which was worth 8 rupees in the stock market at, let's say, 0.10 paise, and the difference between the two is subject to tax at the full rate in the hands of the investor because of this deeming income provisions that we have. So I think it is necessary for IBC cases at least to exempt them, because there is a much larger perspective to be achieved from an India Inc. perspective. One is employment, one is return of money of financial investors who have put in the money into the company, and if those are the larger perspective of IBC, then I think the tax should also help in the process, because otherwise the investor is going to pay that much lesser. And the financial creditors will receive that much less money. So ultimately, that's the balance that needs to be achieved on this case. And in certain cases, they may just not bid, and we may get a lower bid, or we may not get a bid, and things may fall apart. I think that's very, very important, for IBC cases, because the purpose is not about taxation. The purpose is about revival.
Well, yes, that intent there is something that we have to take care of, and not really the quantum of what really the government could generate from that as well. Just let me wrap up the conversation by getting some closing comments. Actually, let me first come to you. Any other wish list that you have from the government this time as far as union budget is concerned?
No, so I think the one other thing that the government, we must compliment the government in doing, is setting up, GIFT City IFSC, which is meant to be, a destination like Singapore or Dubai to attract capital or fund managers in India, and that's a wonderful step that we have taken. I think on that front, there has been some progress, but I think to the point we were talking earlier about clarity and consistency, again, there, some of the regulations need to be sort of streamlined or clarified, and I think that will bring in a tremendous boost of capital that is waiting to enter India.
Anything from your side? Any recommendations to the finance minister?
Yeah, I think, Anisha, India is the bright spot today. So the more we do from our perspective and we help our India Inc. So one of the other things, which is there is that India Inc. is, looking at going outward. And today, if you have a foreign company merging into India, that's a tax neutral treatment that India gives. But if you were to do the reverse, let's say an Indian company merging into a foreign company, then the same tax neutral rules do not apply. So if we want to become bolder and be aggressive in our approach and look at the 5 trillion and beyond that we want to achieve over the next 25 years, I think we need to make those bold steps today and even free up, I would say, the tax and bring in the tax neutrality for outbound mergers.
Okay, gentlemen, thank you so much for joining us today. I think the voice really is quite clear. There are the asks coming in with respect to consistency, certainty and clarity as far as policy action is concerned, a bit of rationalization and streamlining when it comes to the capital gains, as well as possibility of a single window to get the clearances expedited as well, is something that India Inc. is recommending and asking at this point of time from the Finance Minister. With that, it's a wrap on the special coverage coming in on the Budget Dialogue with ET Now as well as Deloitte.